When now know when to buy or sell currency. Now this class we're going to see how how do you know when to buy or sell a currency. Simply in each and every step we're going to take, it is how to know when to buy or sell a currency. Now if you check here, this is a country economy. Now a country economy, here we have a giant machine. Giant machine means those items like factories, the manufacturers of such things, materials, and how international it is from the country. Now, this is the factory. Now, as you can see, this is a factory. These are jobs, the employment from the people. Now, this is the country's economy, drive and supply, demand, exchange rate. This is the exchange rate, how international we are, or how international the job are being applied. Now, the objective, forex objectives bettings on whether a currency will rise or fall against another. Now, the forex objective. Now, if you see, you want to buy euros and you want to travel to America. You have euros. You want to buy the dollars. Now, you see, you will just check the rate of how those currencies are rising. Or in forex, the objective is, if you check at now this point at let's say Euro USD. Now these two, the base and the dollars. Now you buy this. If you predict this euros is going to rise, now you're going to make a profit. If you decide this, if it is going to be strong, then you buy. If this one is going to be much stronger than this one, no, when you buy, this one is strong, this one is weak. Now if you want to sell this one, if you decide this USD is going to be strong, now you sell USD. That is how you make profit, through forex objectives, betting on whether currency will rise or fall against another. Microeconomics, looking at the big picture of an entire country economy like a giant machine. Macroeconomics. Macro means big. How big the economy of the country it is. Now, economy of the country, it is the employment itself in the country. It is also comparing the manufacturing of the machines around, and sort of, it is kind of the growth or standard of the country itself. That is how you measure the economy of the country itself. Economy, that is the business inside that country. Is it international? Is it not international? That is economy of the country. That is how we say it's giant of machines. Now here there is jobs, factories, and those kind of fundamental analysis focus. National productivity, employment number, manufacturing data, international trade, and the central bank's interest rate. Now that is how I'm telling you now. The microeconomy of the country, or the economy of the country, it is how international employment is, how international the productivity of the. Now, if you check at the fundamental analysis of, let's say, USA or United States of America, it is high compared to another economy country, because that country, if you see, it produces even the international goods. Like some other part of the continent rely on that USA goods. People from another continent, they go to America so that they purchase that original product from there. That is how we see the fundamental analysis. Or how is the employment there? How is the standard of living there? That is the fundamental. How manufacturing are we? How fast are we to produce? How many things do you produce? You see? How capability, how international is the country? How can we produce something that is international and we sell abroad from the country? Now, that is the first part on this know when to buy or sell a currency. We're going step by step till you understand how when to buy or sell. This is we are still on know when to buy or sell the currencies. Now there is this Euro and USD. Now this one We see this, the base, this one is the base, and this one is the quote. This one is the one which determines how, if you're buying, it determines the how many it determines the price that you're going to buy it. I mean, like we did see in our last video how you see the pricing of this one from one. If you say €1 is equals maybe $12.88. We did see how you calculate there and how you read the quote. Now the USD, now let's see expected euro strength US. Now we want to illustrate this one. The euro USD. Euro is the base currency. Buy if you expect the US economy to weaken. Sell if you expect it to strengthen. Now this is what they mean. When you buy this one euro, you expect the USA economy is getting weak. Now this is why you expect this one is strong. Now you see this one is strong. That is why you buy euros. You see that is how you see the Canada itself. You see the USD, USA, American dollars. If the country is facing maybe challenges with the economy and those stuff, now it is getting weak. Now you can buy euros, because when you buy euros, you're going to make profit, because this one they're going to get weak. Now the same USD is true. USD is the base. Now this one is the base, yes. Buy if believe Japan is weakened the yen to help its export industry. If Japanese investors pull money from US market to convert back to yens. This is how they mean, yeah? USD is the base, yes. Buy if you believe Japan will weaken the yens. You see? If you believe Japan will weaken the yens. Now, to help its export industry. Sell if Japan investors pull money from US market to convert back to yens. They mean this. This is USD, the JPY. If you see this, the US, if you see this economy is strong compared to this one. No, you buy the USD dollars. You buy this one. This one you buy. You compare this one to this. Now JPY, if you see the economy of that country is weakened by maybe USA transporting and getting things from there. When Japanese come to get things from USA, this economy is weak. So we mean this one is you buy because it is strong. Now if you see the investors from Japan, the investors themselves from Japan, they are coming to now the USA, we are going to purchase things from Japan, meaning that country is strong. It is weakening USA. Now this economy, it might be high, because if USA can purchase things from Japan, meaning USA cannot afford. It is weak, cannot afford. Now that is why JPY, that is the Japanese yen, will rise. Now that is when you sell. You sell this, because you expect when you sell this one, they are going to weaken the dollars. This one you sell. The quote you sell. Get? Yeah. The same to the British foundation, British pound and the USA. GBP is the base. Buy if the British economy outpoint the US economy. Now if this economy of the GBP or British USD, if this economy is high, this is strong, and it will change the economy of USA. Now you buy this British pound. If you buy this British pound and you realize later USA dollars, the dollars themselves, they are weakening this one. Now they're getting strong. Now you sell these pounds to dollars so that you get profit. That is how you read you know when to buy or sell currencies. Yeah. This one, know when to buy or sell a currency. Now this one, we will check something we call the lot. What is a lot? Lot, LOT. Now this one, lots. Now, there is this first says that you can't go to, let's say if it's a rule, you can't go to a supermarket to buy one egg. You can't buy one egg. The same to that one. That is what we call a lot. You are supposed to buy as a bulk of a crate. That is of maybe of or 12. That is how you're supposed to buy. Now, an example with the currencies, you can't buy one currency, you can't trade with one currency or one British pound. No, it is not. You're supposed to trade with bulk. Now, notes, currencies are traded in bundles, not individual. You can't trade in one or individual or just one. You have to have a bulk. The micro note, the small one, it consists of 1,000 units. The small one consists of 1,000 units. The micro, that is the mini note. Mini note is the minimum. Mini note, it consists of the 10,000 units, and there is the standard lot, that is 100,000 units. Margin and average. Now we will see on the margin and average. Average is the ratio of your total position size to your actual cash deposit margin. Now, there is two explanation of margin and average. Now, margin, it is something that you hold. Okay, then we didn't look at someone we call the broker. The broker. Now, this broker, you give, let's say when you are trading maybe Euro USD, maybe Euro USD. Now, in this, there must be a broker. Now, in this broker, you're going to say maybe you're buying this one. There is that money you should have in your account that you bet with the broker. You say, I'm capable of risking this $20 or covering this loss of $20. It's like you're giving someone money cash. Okay, you render someone a cash. You say, is the way company give loans, or the banks give loan. Now, if you're capable of, they see the consistency of how you have been saving your money to those banks. Now, they can give you that loan knowing within the course of this period of time, you will have sorted that amount of money, because the way you are earning or the way you are saving, it is more than the way you are borrowing. Now, here, the broker will give you, if you have $20, you deposit $20 on your account. The broker promises you can trade maybe this one with maybe $2, $3. That is, you can even risk that one for a loss. And it's something like you promise your broker, like, I can risk this one for a loss, and then I can cover this one for a loss. It's just like the way banks do. The other thing, that is what we call the margin, the deposit you make so that you can open your trade and make sure that if I open this trade, I will trade with maybe $1. I can risk $1 and cover my losses now. And when it covers your losses, you cannot, the trade closes itself. That is the broker pushes you out of the trade on, closes the trade. That is when you go loss of that. Now, leverage, it is when you get that money, let's say you deposit that margin. You deposit, maybe you have $20. You deposit $20. You say, I can trade the euros with this $20. Now, the broker himself, you don't have a lot of maybe $100,000 to trade those backing notes, these ones. You don't have that money. No, he gives you the ratio. That is the ratio of an example here. He can give you a ratio of, if your account will trade with $1, he can offer you another $50. You can trade a trade of $50 with your $1. Now, this is the ratio the broker gives you a chance of multiplying you can even trade more the gold and those things with high amount of back of money with your small account. Now, this gives chances to those small account or the active small account to grow step by step. so that they reach this point of a lot of dollars, because not everyone can trade with $50. There are few and some. The others now, the broker here guarantees you can give you $50 leverage. If you set your leverage to 50:1, now the broker gives you $50. So you can trade and by any chance, let me advise you one thing, the traders. By any chance you happen to open your trade with small account or small active account, and when you bet that small account, let's say you want to buy euros with this leverage, the sort of leverage here is very high. If there is a teeny rise or a teeny possibility of your trade is going to make a profit, you get a very huge profit with this small account with this big leverage. Now your bet, if it comes true, you get a very huge. If you happen to lose this account, this trade, it is going to blow your account. It is going to blow your account. Even the small you are, this $1. That one there, the broker owes you money now. See, that is what we say. Using 50 leverage, 2% requirement, setting aside 3,000 allow you to control $130. Position of GBP, reserve, present side. You see, he is going to give you that chance of operating with big bulk of dollars. That is, if you have a small account, you can start trade. That is how you do or sell the currencies now. Now this day one open position. Now this one we check at the time the banks. Okay, let us see. No over fee, a daily fee paid or earned for holding a position past the 5 p.m. ET market. Now in this case, the bank itself, there is that bank, they give you interest for holding your money. Also, when you borrow money from the bank, you pay with interest. Now this is how it is. Now many banks past 5 p.m. That time the forex market doesn't stop working, but the banks themselves here, they again closed. But banks, that is banks, but forex market, they do operate. Now here, interest, you pay interest on the currency you borrow. Now when you trade currencies, that time when the banks are closed, you see, past 5. No, but it is recommended you trade not past 5, but before the bank closes, because the interest on the currency you buy difference. If your currency with high interest rate than the one you borrowed, the net interest is positive and earn money. If the lower, you pay. You see, if the interest of that trade, that when you are trading, when the banks happen to close by 5 and you happen to trade, if you earn interest on what you are trading, you see, if you earn the currency with high interest than the one you borrow, the net interest is positive. When you earn lower, it is a debt. It's supposed to be, and that is the interest too. And this is know when to buy or sell currencies. That is the procedures.